Good evening, everyone. Thanks for coming. I'm very pleased to be introducing our main speaker and also the person who's going to be moderating the event for us tonight. So we have Anat Admati, who's going to be talking about their book, The Banker's New Clothes, written with Martin Hellwig. We also have John Plender, who's going to be moderating. So Anat is professor at the Stanford Graduate School of Business, has written for the New York Times and the Financial Times, and has been included in Time's 100 Most Influential People and Foreign Policy's 100 Leading Global Thinkers. And John, who, as I've said, is going to be moderating, is a Financial Times columnist. He has written for the FT since 1981, before which he was the financial editor of The Economist. He is a winner of the Wincott Foundation Senior Prize for Excellence in Financial Journalism.
So, good evening, everybody. It's a great pleasure for me to be able to introduce Anat Admati to you, who has produced a revised and updated version of a book first written, I think, in 2013 with Martin Hellwig, which made a very powerful case about the failures of regulation and excessive risk-taking in the banking system before the great financial crisis. And the new book has got a lot of new and fascinating updating in it, and she is going to run you through what she has been writing.
Thank you, John, and thank you, King's College, Paul, for organizing, and all of you for coming. So I'll talk about our book, and then if I have time, and I probably won't, but I may sneak in a little bit of a broader context, because kind of in the last 11 years, and it's been total of 15, kind of in this debate, I took a break between 2016, 17, and more recently coming back to this for a reason I am not even sure myself, but somehow took this on. So we'll get to see what it is, and that's the broader context, because I came back to ask, what have I seen, what have I learned from the experience of 5 or 6 years of full-time in the trenches, writing and speaking and debating and all of that. So there was this crisis. I mean, I teach young students for whom this is long history. They were in elementary school or whatever. So, you know, it's history for them. But I think looking around the room, most of you were certainly alive, but even may have been an adult. And these were the kind of headlines in the Wall Street Journal about Lehman Brothers and AIG. This was 2008. We call it 2007 to 9 because it really started in 2007, and we were still feeling it in 2009. There were a lot of bailouts, and we'll talk a little bit about bailouts today. And there were real economic impact. People lost their homes. There was a lot of unemployment. There was a big recession. So it wasn't the Great Depression, but it was a pretty great recession. So the real people were impacted. It wasn't just a little correction in the financial markets or something like that. Looking into it, coming at it from a perspective of a finance expert doing governance and other parts of finance into banking, it really was falling in the rabbit hole. It's very much the experience of Curaçao. And Curaçao, the same Alice in Wonderland, fell in a rabbit hole because it was, I came across things I didn't really understand. And now I do. I can't quite go back to where I was. My innocence has been robbed. I've seen a lot of politics and a lot of confusion, shocking amounts of both. So I'm starting very quickly with narratives, because narratives inform policy, okay? And I'm starting with the greatest economist of the 20th century, Ken Arrow, who wrote a month after the failure of Lehman Brothers that we have to rethink everything. And this is the guy who, for those of you who know economics, was sort of talking about securities that would span all markets and everything would be nirvana, complete market, you know, first best, everything. Great. And he's saying, we got to rethink everything. Maybe these, you know, naked credit default swaps are not for the better or whatever. So a month after the crisis, he's saying something really, some of our assumptions were wrong, basically. However, another narrative is stuff happens. That's the Jamie Dimon narrative. This is the CEO of JP Morgan Chase till today. And he said to the Financial Crisis Inquiry Commission in the US, stuff happens. I told my daughter, a crisis is a thing that happens every few years. So it's a different interpretation of it, which sort of says it's sort of like a natural disaster. This is a favored narrative that says you can't prevent these things. It just sort of happens so often. Send the ambulances, send the help. That's the narrative, unpreventable. And what about what happened in the last year? In banking, they love the word liquidity. We're going to talk a little bit about that word. It's the plumbing, it's liquidity, it's runs. There's a big fascination with that, okay? Movies, the whole thing. There was a Financial Crisis Inquiry Commission in the US, and you had your Vickers Commission. There were commissions all over the place. And they concluded, at least a majority report, concluded that the financial crisis was actually avoidable, that it showed all kinds of issues that were true. Lack of transparency, inconsistent responses. Here's Bear Stearns is bailed out. Lehman Brothers allowed to fail. They, sending. And there was basically breaches of accountability at all levels. Okay, so it reflected what I call a governance failure. People making decisions, other people are impacted. And one of the things that we narrowed in on is the thing about debt. So the world is awash with debt. Our discussion writes about that too. And we have a debt-fueled economy across the board, but I'm a corporate finance expert, so I'm going to focus on corporate borrowing, and especially bank borrowings. And banks are corporations. So when I stepped into it as a corporate finance professor, academic, I asked, how are banks different from other corporations? And that's the starting point for somebody like me. What's the same and what's different? They tell you it's very different, but that's the way they like to think about it. So to very quickly show you what that does, one of the things that does is it magnifies risk. So if you put 5% of the value of a house into a house and the rest is borrowed money, you are taking a leveraged position in the house, putting $20,000 to buy something worth $400,000. And what happens is then, ignoring interest and other things, if the house goes up in value, you make a lot on your small base. So it magnifies the upside, 5% the value of the house. If you bought it all with your own money, there'll be 5% return you'll get. But if you bought it with only 20%, since you get all the upside and you pay your debt, you have a lot left relative to your investment. You doubled your money. Here you tripled your money with 10% increase in the house. Of course, it doesn't look so pretty on the downside, because if the house loses 5% in value, you lost everything, kind of on a snapshot anyway. And if the house goes down by 10%, you're what's called underwater. This is going to be the equivalent of an insolvent institution that cannot pay the debt from selling the asset, from selling the house. So the house is worth $360, but you owe $380. So she is going to either walk away, depends on what the contract they have, or she has to pay out of some other money to settle that debt, or maybe she stays there and it comes back up, but she's underwater in this situation. This is just a picture of a balance sheet of a corporation. Again, the color scheme is the red is debt and the green is equity, and that's just a schematic for all corporations, what they owe, what they own, or the assets they have, and how they fund them on the funding side. Now enter banking. So start with the fact that deposits are debt to the bank. We don't behave as much like creditors, but they do owe us the money. They forget that sometimes. And there is this liquidity problem, which has to do with the ability of somebody who borrows money to convert their assets to cash in a timely manner, so they can actually pay what they owe when it's asked, which in the case of deposit is any time, right? You can come to the bank and ask for your money back. It's not a debt with a fixed payment schedule. It's demandable debt, so they have to have the money. And if they made loans and something is illiquid, then they might have a liquidity problem. If everybody comes at the same time, there might be sort of this panic or run. So that's what you'll see in the movies. And theoretically, runs can take down a healthy banks in the models, even Nobel Prize winning models. It can just happen that suddenly everybody is afraid that the other person is going to take the money and there's not enough asset and whatever. But we're not in that world. And actually, it's very rare that it would happen. And deposits are insured today anyway. There were many, many runs. And by now, what we have is an enveloping safety net around this system. So that is very, very unlikely, even though it does happen. If you're uninsured, it did happen. Okay, so historically in the United States and the UK, equity levels, the green stuff relative to the total, kept going down over the years. So in the 19th century, you would have partnership with 50% equity, unlimited liability for the owners, and only then deposits will trust the bank. No deposit insurance, no central bank, nothing like that. And then banks became limited liability corporations much later, together with the putting in place deposit insurance and safety net that would prevent the default. And they therefore wanted to and also could get away with having less and less and less equity. Okay? So this is the color scheme of sort of corporations in some sectors that hardly ever borrow, and kind of an average corporation. And even though we give a tax advantage to debt over equity, corporations never get to live like banks do, even though we don't regulate that. Okay, so you look at for a sort of reality check at what the market tells other corporations, and you know that there'll be some pushback somehow by creditors, you know, that would make life difficult if you have a lot of debt as a corporation. And so you might, you know, use your retained earnings or issue more equity so that you can comfortably invest and not default and not fail in all of that. So here's your bank, Barclays, in the years leading up to the crisis. Deposit funding, the funding for money market funds, which are just a shadow bank institution standing between the depositors and the bank. You give your money to the money market fund because you want some higher interest. They lend it short term to the bank, but the bank owes them the money, needs to return it the next day or renew the debt. More debt and a tiny, tiny bit of equity. So the bank is growing, the equity is very tiny. No wonder it's very fragile. In addition, you have a very complicated and layered system that's very hard to see through from the beginning person, from the sort of stories of banking to the end, from the person who invests to the person who borrows. It's very complicated inside, lots of things. And this is the kind of picture they drew in the New York Fed, which is not meant to show you the details. They were basically making the point that they opened lots and lots of windows for you to come and get supports during the financial crisis. So come to the closest window to that we will help you. Okay, so here's what can happen when you have a lot of these very leveraged institutions and various mechanisms of contagion. There's a financial crisis. Okay, so one falls on another, or people start being afraid of the other, or there are all mechanisms that we discuss in a chapter called Banking Dominoes about the dynamics of that. Now, why do they hate equity so much in banking? The other companies have plenty of equity, certainly relative to banks. They say it's expensive. That's the mantra in banking, expensive. In what sense is it expensive? To whom is it expensive? That's the question that we started asking. If you tell me, oh, I'm going to, it's going to be more expensive for me as a shareholder of a bank, that could be because it's expensive for me to not be able to reach into Paul's pocket and steal his money. It's expensive for me privately. But socially, we decided that he should not reach into his pocket and take his money. So therefore, we might reduce your ability to extract subsidies or shift the risk to somebody else. But that's as it should be, probably. So here's more like the situation. Our borrower, Kate, maybe has an aunt, and that's our chapter on sweet subsidies, who tells her she can go buy a house and the aunt will guarantee it. Now she can get a cheap mortgage at a low interest rate and the bank doesn't care if she puts a down payment or not, because the aunt will pay if she can't. So she can buy a house with zero equity. And why buy a small house? Buy a big house. Because it's all other people's money. You don't have to you don't need any money. Okay, so now you want a bigger house, all with borrowed money. As long as the aunt is good for the promise of the guarantee, Kate can have fun in a big house. Take the upside, she sells the house. Downside, she apologizes to her aunt, and that's that. And if her aunt says, why don't you put some of your own money, she tells her equity is expensive. Because if she puts the money in the house, she might lose. But if she keeps it out, she could put it in, safe interest-paying something or other. And she won't lose. Okay. So the banking system has lots of Uncle Sams, meaning people who, institutions around them that coddle them in that way. So we have deposit insurance, which is run in different ways in different countries, but certainly in the developed countries. It gives guarantees, certainly to deposits, but oftentimes beyond. We have treasuries that step in to back up the central bank, to invest directly, to take over, all kinds of ways in which they come in to help. And they do all these things, and you have the central banks. In the new edition, we explain how they work. Before, we referred to them a lot, but didn't explain them as institutions. And now, in the last 15 years, they've become more and more active in markets and in supporting institutions, and both governments and private sector institutions. And so they are a lender of last resort. They'll come in and they'll say, oh, I'm just lending to a solvent bank, but maybe not. They subsidize loan. They do QEs and they buy stuff. And why they do this and how they do this? Well, how is because they can and they want to. And they tell you it's all for us. So, maybe yes, maybe not. Then they have to worry about inflation sometimes. So all of that we don't get into in the book. That's way too much for us. And then in the US, there are all kinds of other institutions that backstop mortgages, that and lend to the banks and all of that. Here's just one example from the financial crisis. There was an FDIC program that enabled banks, even newly created banks, that were investment banks like Goldman Sachs and Morgan Stanley, to do exactly what Kate could do, which is to go to the market and issue bonds guaranteed by the FDIC. When they could do this, they could easily raise money because everybody's going to lend them money if it's backed by the US government, basically. And then they can go back and pay the government for the bailouts that the government gave them, which had a few constraints on them, on compensation and on dividends and things like that. So once one part of the government helped them pay the other part of the government. So they are kind of interlocking. And we quote in the book, in the epigraph, it's an infinite subsidy. In other words, just your ability to go to market and raise money is like Kate being able to buy a bigger and bigger house. So regulation. I will not go through this slide, but there is a committee in Basel that is supposed to coordinate rules across many countries, and then each country needs to put it in their own law and however they work, okay? And they started in the 80s with this thing called Basel I, and then they had Basel II, which was a spectacular disaster. I'll show you. And then after the crisis, they came up with this Basel III, which is when a bunch of us woke up to say, wait. No, you totally and entirely. You tweaked Basel II in some way. You didn't change some really bad things in it, and not good. And this is still being debated years later, right now, in the US or even in Europe. Basel II was a spectacular failure, which we saw in the financial crisis. It was not just it was a lot of the design of it. Okay, we don't have a lot of time. But let's just see briefly. They have a thing called Tier 1 capital ratio. Okay, it's technical, but never mind. Suppose it's 8%. And Andy Hellwig at the Bank of England did a study in which he took banks that needed a lot of bailouts and banks that needed less bailout. And if you're sitting by the radar of these capital ratios, you won't even know there was a crisis because this is like the Lehman Brothers bankruptcy right here. And everything looks great on all the kinds of banks that needed bailouts and the ones that didn't need bailouts. And 2006 was a great year. After the summer of 2007, when housing prices started going down, still everything looked fine. Banks were paying a lot of dividends, depleting the green stuff. Okay, lots of dividends paid in the US, $80 billion of dividends, just the top banks. And then when everything started happening, they got enormous bailouts. The same 19 institutions that just paid $80 billion got $160 billion in direct government investment. The Federal Reserve was pouring money into the system, committing trillions of dollars to market. And all these other thing, tier 2 capital, all this debt that's supposed to absorb losses, none of it absorbed losses except in Lehman Brothers. So everybody who was promised, even though they were meant to be a backstop, they weren't. They were paid in full. The market values of the sick institutions would tell you that. Say Citigroup or some of the sickest banks, the market value of their equity stock market was down. Citigroup almost came down to zero and was bailed out again and again and again. That was our zombie. So the headline numbers here are ridiculous, just ridiculous. And also they come as a ratio with something called the risk weight. 20 of us published a letter in the Financial Times, which was supposed to be a comment in the comment pages, but got relegated in the letters section, which is better than not being published at all, I have to say. But it had to make space for the CEO of Citigroup the next day to publish an op-ed saying all the nonsense that they say. But we said, 20 of us, that against the 3% of Basel equity to total, 15 is just the start. Okay, many of us were willing to say, in the book we say 20 to 30. Nothing wrong with it. Nobody ever told me why anything's wrong with it. So I'm still waiting for an answer that makes any sense. And we said to start with, stop the dividends. So it's not like, because we understand about. So I'm going to skip the risk weights, but they are. A risk weight of 0 means that you just ignore it in the denominator. It's an asset that might be risky, but you don't count it at all. For example, Greek government debt, not counted for French banks. And then that 0 risk weighted, if it's rated AAA, not counted. So they ignore risks. It's political, it's manipulable, it's bad, and that's kind of playing out in the background of a lot of the debates. So this book, I'm bragging here about all the, praise it got, but mostly to make the point that despite this, we failed. Despite this, we failed. The book got every praise you can imagine from smart people, and it wasn't enough to change much. I know we can debate what could have been expected, but I certainly, in my naivete, expected more than we got. So some of the nonsense, so the Banker's New Clause refers to claims without substance that are flawed. Okay, so we're exposing them as such, just like the emperor's wearing clothes that are, not there. That you thought you are stupid or incompetent if you don't see them. And here, same thing about claims made in banking that might seem intimidating to you. You might not understand, but you might not want to admit it, whatever. So here's one. Capital, this word, is a rainy day fund. That is false. It's just false. It's in the wrong side of the balance sheet. I'll show you in a second. Okay? It confuses cash reserves with equity funding. Cash reserve has to sit, or they choose to keep it in cash. In fact, these days, they keep it in cash in the central bank, get a huge amount of interest, much more than they pay us, okay? And the equity funding is perfectly good to use. You just paid a dividend. That means you depleted your ability to lend, okay? So all the stuff they say. Every dollar of capital is $1 less in the economy. It's just nonsense. It's just absolute nonsense. And they keep saying it. This was early. This is in 2015, after the book. It doesn't matter what you say. They keep saying it. It doesn't matter if you write a book, a year and a half in the bunker, after saying it in short way. Doesn't matter. They keep saying it. So here's Paul Volcker saying, it was in a book that we didn't cite in the old edition, but now we do, a book called Payoff, Why Wall Street Always Wins. And in this book, a staffer to Senator Ted Kaufman describes a conversation between the senator and the late Paul Volcker, very famous central banker in the US, saying, whatever you want to do, they'll say credit and growth will suffer. It's all bullshit, he said. So sometimes when I don't get a lot of time and I'm in a debate with somebody who's going to say some nonsense, I'm going to say, well, I have to hear what precise bullshit they say, and then, if you give me time, I'll respond to that. So in the real economics of it, why might you default? So you might have a liquidity problem that you have some great asset, but you didn't sell it. So that's in principle possible that you might default for that. Or you might actually have a more serious problem, which is what is a solvency problem. This is about the ability to pay, okay? So the source of the liquidity of the problem matters greatly. And if you deplete your equity, you're less likely to be able to pay. Okay, so this is a paper we wrote in 2018 that explains how addictive corporate borrowing is to the borrower. Somebody has to push back, or a borrower, a corporation wants to keep borrowing once they borrow, or they're biased in favor of more borrowing. And we explore all the adjustments and deleveraging and all of that. So the extreme form of the insolvency has symptoms. So if you think of me as a corporate doctor, I'm saying if you show these symptoms, I get very suspicious about your health as a corporation. The fact that you hate equity with this intensity shows you have very little of it, because that's what happens. And especially if you're unable to raise equity, which is also what happened to SVB, that's the kiss of death. Nobody will give you any money for a share of your stock, given the debt you already have. That is clear market signal that you are failing a market stress test by my book. Okay. All kinds of symptoms that are based on our research show that, you might want to live another day and claim it's only a liquidity problem, but that in fact you have a much deeper problem, which is somebody's going to have to lose. You will not be able to pay your debt. And of course, if you get bailed out, then you don't default and everybody could be happy. Now, the way they hide insolvency is sometimes through the accounting rules, okay? So the accounting rules sometimes allow you to overvalue your assets, and then you can pretend that you are okay. And so there are smart people, very shrewd investors that say that the bank's disclosures, especially the largest ones, are completely black box and you cannot understand anything. There's too much risk. There's too much off balance sheet. This was in Davos with me, was Paul Singer from Elliott Management, a paper by the IMF saying that there's a lot of off balance sheet liabilities. So what happened recently? It was a concern for solvency that led to the run, that led to the failure. Credit Suisse happened, all of that. Had they been funded with 20% equity, we wouldn't have the problem. Now other banks have to pay, and now all kinds of things are going on. KPMG, the auditor, gave them clean marks just before that. The regulators gave them good ratings, camel ratings, they call them in the US. So all the gatekeepers and the watchdogs failed, basically. They'll blame the management. But what happened in this case a year ago, 14 months ago, is that the Fed, the Treasury, and FDIC basically bailed everybody out. Of course, they were going to tax somebody because the money's got to come from someplace, okay? So they say, oh, it's not taxpayer. Well, it's the other banks. The other banks are, people too. They're not the people who took the debt. They're not the people who led to the failure. But most importantly, and the reason that we included explanations of central bank is the last bit that the Federal Reserve announced that they will make more loans to more banks, overvaluing their collateral, what Martin Wolf called a hair graft instead of a haircut on the collateral. Meaning you have an asset that you say to the central bank, okay, give me money, I'll give you this asset. Your asset's worth, $800, but they give you a $1,000 loan. Obviously, that's risky for the central bank to do. Usually they don't do that. They value it at market, but they are saying, we'll lend you as if your asset's worth more, even though interest rates went up and your asset value went down. So that's what they want you to think is no bailout. Okay. Even more outrageously, over the holidays, we had a situation in which in the new lending program that they started in the US, they were lending to the bank for 1 year, up to 1 year, at 4.87%, but they were also paying them 5.4 on deposit. So the bank would put the money, get 5.4. So it was a great windfall for the banks. But, the 5.4, this is, by the way, this is now in the UK. I just checked this the other day. So your central bank is paying your banks 5.25% interest, okay? I don't know who here gets 5 1/4 on deposits, but if they don't pay you, they're just pocketing the difference. So that's like the easy way to make money. Why bother making a loan to the business? They'll threaten they won't, but why would they? So staggering scale of how much money they make just from that. Oh, they're trying to make it fairer for you. So this is the new part of the book. It grew fat. So the book grew fat. And these are the 4 new chapters. One of them, and I'm giving you the epigraphs of the 4. Without reform, it turns out to be from England, some of them, from UK. Mervyn King saying in his book. And then the next one is about central banks, which was also about your little crisis with Ms. Truss, where they stepped in, the Bank of England. Bailouts Forever is about Credit Suisse and how they were saying, oh, never mind that we told you for 10 years that we were going to do bail-in instead of bailout. We got to do bailouts. And they did. So the parade continues. We keep updating a document that now has 44 different. So in the grab bag of flawed claims, they'll look at you and decide what might resonate with you, and they'll say some of these things. Okay, and this is all available online. We group them by the type of claim that they are. There are 44 total, and you can hear them right in a hearing before Senate from a senator saying, let's translate it. It's the money on the sidelines. Okay, same thing as what I started with on the nonsense. A senator in the US in December 2023, so just a few months ago. Okay, and here's the New York Times, 2024, in multiple explainers saying capital is a cash-like asset. No, not true. Now that's how they're explaining to the public. No wonder the banks get away with muddling this whole debate. They have a website, Stop Basel Endgame, terrible things will happen, everything will be more expensive, all of that, all the bullshit. Credit will suffer, I'm going to do that debunking. This is your ex-governor here making the promise that no more bailouts. He conquered and dealt a death knell too big to fail. He was a big, big hero at the time. We already had the book out, and we were skeptical. And so that's what we started writing, that, they'll have some button that they'll press, and all of a sudden the bailout will become a bail-in, and some creditors will just quietly agree to good luck. Over a weekend, they'll resolve a Credit Suisse. Good luck. They didn't put in place the machinery for it. They were unprepared for it. They were basically lying to you, that we don't have any more too big to fail problem, that there will be no more bailouts. That's what this is. Instead, they always press this other button, this bailout button. And that was Credit Suisse. It was a zombie for a while. It had all these problems, and then it was bailed out, and the Swiss taxpayers are paying for this. Okay, it's a small country, so good luck to them. Switzerland, turns out, didn't even have authority for their regulator called FINMA to even do anything about Credit Suisse all the time, but FINMA didn't even say that it doesn't have authority. So you wonder how come now a parliamentary commission is saying that. So they'll always say, oh, you can't regulate me because the other guy is not regulating them. So got to have a level playing field, which is the race to the bottom. Okay, all these successful countries like Ireland and Iceland, they worked great for them to have successful banks. And if you were here in the UK, you want to have a successful champions in banking, then really let's hope for you that it doesn't explode. So they're still the most powerful lobby. And here's Martin Wolf in his review of our book. First time, he said, banks are not special. This is basically what our book says, except for what they get away with. And then he says the reason that this is not more widely accepted is, first of all, that the bankers have so much influence, and secondly, that the economics is poorly understood. The economics part we did. We explained. So then he says, read this book, then you'll understand the economics, and then you'll see why we didn't solve this problem, and he came out of the Vickers Commission to tell you that we didn't. We're hostages to the banks for all kinds of reasons of political economy. The central banks are bailing out, they confuse you, everybody else gets ignored. And in the final bit of it, and in the final chapter of the book, we go much more in detail to the lawlessness in banking. This is a book that interviews a bunch of people from the financial sector in the UK by a Guardian journalist who's actually from Netherlands. And he said, oh, you say we didn't learn anything? The bankers learned there's nothing they can't get away with. And that's basically nobody going to jail. This is the New York Times 10 years after the crisis, leaving the entire last page of a section empty, saying this is intentionally blank. All the list of CEOs that went to jail, blank. Nobody, okay? So they pay a lot of fines. This is the rap sheet of JP Morgan Chase. In the book, we go through the $13 billion settlement. These are 3 books we did not cite because we didn't know about them, and some of them are new. One of them is about HSBC. Our last chapter is called Above the Law ? And Martin Hellwig, my co-author, recently started saying that we would put exclamation mark on it if he had read this book about HSBC. HSBC basically engaged in massive money laundering in Mexico, and it was your government in UK that pressed the US authorities to go easy on HSBC because it is your national champion. It takes a village to maintain this system, and it includes private sector people who benefit from this system, but it also includes a lot of people whose job it is to do better than what they're doing, okay? Including the academics. This is something that a banker I met who could read the academic paper said to me, and I sometimes throw in front of academics, when he said the academics are the problem, and I know they're part of the problem, and he, after quoting something from an academic paper, said to me, with such friends, who needs lobbyists? So most recently, I submitted policy comments. You can find them all, and this is an op-ed from just a month ago to the day, summarizing this as nonsense and bad rules persist in banking, and the extra is that I've written now about capitalism and laws and all the false things. This is a volume on capitalism that asks some of us what's gone wrong. And my diagnosis of what's gone wrong, that's for later if we're going to stay with banking, is that the forces of so-called capitalism have overwhelmed our democracies, and that deception is a key tool in markets and in politics. And that's part of the problem. Thank you.
Well, thank you so much, Anat. I've been asked to act as a discussant, and I take that to mean that I should just highlight a few of the points that you've been talking about and talk around them a little before opening up to the floor and inviting questions from our audience. But anyway, strong meat, as you see. You've got the full Anat there, and it's a salutary corrective to the official wisdom of bankers about the safety and soundness of the financial system since the great financial crisis. The argument usually being put by the bankers that the system has been recapitalized and substantially re-regulated and therefore is in much better shape. Well, obviously that took quite a knock with Silicon Valley Bank and Credit Suisse going to the wall. And I think that what Anat says with Martin Hellwig very persuasively in this book is that you can even put the case that banks are more dangerous today than they were back in 2007 to 2009. And I think that what is so well highlighted here is that within a limited liability system, you have in banks corporations which are extraordinarily highly leveraged relative to everywhere else in the corporate sector. And on top of that leverage, you have the basic problem of fractional reserve banking, which is that depositors are able to pull out their money at the drop of a hat. And if you combine those two phenomena, you've got a very unstable structure through which you are doing financial intermediation. And that's, the way it has been. And the lessons that were learnt, we thought, in the 1930s were that you need to have good regulation in order to keep a lid on excessive risk-taking, excessive leverage. And it was interesting to hear that quote from Jamie Dimon telling his daughter that financial crises were things that happen every 5, 7, or 10 years. But in fact, if you look at what went on in the banking system between about 1945 and 1970, there weren't many financial crises. I don't think there was a single global financial crisis, was there, Anat? And so...
there was savings and loan.
Before 1970?
Oh, no. Right, that was in the 80s, yeah.
And the reason why the crises started happening was essentially deregulation. Starting with the breakup of the Bretton Woods semi-fixed exchange rate system, severing the link with gold was in effect a form of deregulation in the foreign exchange markets. And almost immediately after that, the crises started coming with the collapse of the Herstatt Bank in the mid-1970s. And then, in addition, you had in the early 70s a quite strongly ideological push by politicians for liberalisation of banking. And in our case in the UK, the Heath government introduced its policy called Competition and Credit Control, which was a liberalisation measure which unleashed a huge credit explosion, which was followed very shortly afterwards by a massive property crash and banking crisis, which was known as the secondary banking crisis, but it was a financial system-wide crisis. So I think that it's not a case of stuff just happens that we have financial crises. There is a balance between sort of regulation and deregulation. And for a very long period, until the regulatory measures were put in place by a lot of governments around the developed world in the 1970s, banking operated in a very utility-like way, in which risk was controlled very substantially. And that meant that the bank's very dangerous capital structure and very dangerous funding structure didn't get out of hand. That it was a relatively low-risk system. And that all changed with the...
It was also derivatives and securities.
Indeed, and financial innovation, of course, then compounds the problem that you have with a structural set of weaknesses. I think one of the things I'd like to highlight about the book is that there is much emphasis in here on incentive structures. And that's good, because I think so often economists are not very good on the behavioral aspects of why things happen. And that's particularly true in finance. And the thing that has really bugged me a great deal since before the great financial crisis is that you have a bonus culture in banking, and you have pay packages which rely very heavily on metrics for performance-related pay, which can be related to things like earnings per share. Now, if you have earnings per share as a metric for a pay package, it is in effect giving the chief executives a powerful incentive to shrink their equity to bump up their bonuses. So it's absolutely destabilizing for a financial system. And it's entirely understandable, given those incentives, that bankers are doing stock buybacks and engaging in creative accounting to get the earnings per share up and to get the equity in their balance sheets down. And that, it seems to me, is a fundamental Achilles heel of the way the financial system works behaviorally. And I think that we get a very good insight into that in the book here. I think the other incentive that's worth highlighting is, as Anna mentioned, the political incentives. I mean, the fact is that, Capitol Hill has been bought. But actually, this is a wider problem than just banking. Capitol Hill has not only been bought by Wall Street, but it's been bought by the Business Roundtable and the Chamber of Commerce and by wider business more generally. And it is an issue about political funding. And if politicians are funded by bankers and big business, then it's back to the point Anat raised about power. Really, what has gone wrong in the banking system is substantially to do with power structures, as well as the inadequacies of the capital structure and the funding structure of the way the banks work. And I think if you look at it in terms, and that that explains why it is that that society has been so soft on these bankers that nobody did go to jail except some small fry. And if you look at the UK, it's very interesting that we're not quite the same as the US in the sense that, on the one hand, before the financial crisis, governments looked to the bankers to help them with treasury revenues, tax revenues, and also to generate jobs growth. But somehow, while there was a culture of deference for a long time, it seems to have got a little bit off beam, so to speak, in the last decade or so, because with Brexit, for example, the politicians did nothing to help the financial community with the difficulties of a new regime that would arise from Brexit. Having said that, though, we now, I think, are seeing, and again it's highlighted in the book, that there has been a considerable pushback by the bankers, a lot of lobbying, and that the politicians are once again being very quiescent in responding to what is going on in the banking system and listening very sympathetically to what the bankers are demanding of them. And there's a curious thing that even some of my colleagues on the Financial Times have got this idea that the British are good at banking. Well, if you accept Anat's analysis, that is rather like saying that serial killers are good at murder. The fact is that bankers have this capacity to inflict huge negative externalities on the economy and on society at large, which is what happened during the financial crisis. And therefore, and I would also add that if you read any of the accounts of the collapse of RBS or Lloyds Bank, Bank of Scotland, the incompetence of some of these bankers, openly admitting that they were having great difficulty understanding the mechanics of structured products and asset-backed securities. There was a phenomenal amount of incompetence going on in the financial system here, but it was also the same in New York, where you had J.P. Morgan, for example, with the great whale scandal. All the top executives in New York hadn't a clue what their bankers were getting up to in London with all sorts of derivative trading with enormous leverage. And it came as a great shock to them when the London whale scandal broke. So I think we have been probably certainly far too deferential towards bankers in this country as well as in the US. I think the final thing perhaps I should say, just to is to focus on the big issue of moral hazard that arises from all the bailouts. The fact is that we're in a position now, as Anat implied, that everybody in the financial system assumes that if things go seriously wrong, there will be bailouts. And that means that it helps explain why it is that at this point in history, we're seeing public sector debt in the developed world at levels that have only previously been seen in wartime. And it's partly because this morally hazardous bailout system and an asymmetric approach to monetary policy, whereby you put a safety net under the economy or the financial system when things go wrong, but you put no ceiling on what happens to credit in the period of credit market euphoria. And that, I think, is profoundly destructive and dangerous. And nobody in the policy fraternity is talking constructively about what, if anything, should be done about that, although there is some academic discussion going on about better ways to do debt restructuring and so forth. But I think the concluding line has to be that Anat and Martin Hellwig have just highlighted an extraordinary lack of accountability that operates within finance, whether you're talking about the bankers, the regulators, or the politicians. This is a very privileged community of people who've been getting away with a hell of a lot. Now, I think we shouldn't go so far as to say that there are no good bankers. There are many honourable bankers trying to do a decent job who do want to sort of lend well to the economy and to households. but the structures are very badly formed in incentive terms, and that is something that is not high enough by a mile on the policy agenda at the moment. So with that, I'd just like to hand things over to you on the floor and ask you if you'd like to raise questions with Anat about her presentation, or indeed anything else to do with the issue she's covered. Please go ahead, but let us know your name and organisation when you raise the question. Who would like to kick off? Martin.
Martin Wheel, King's College. So John mentioned Martin as the microphone. Thank you very much. John mentioned the issue of bonuses, but one point that, as far as I remember, neither you nor he made is that bonuses inherently lead to capital starvation, or at least profit sharing arrangements do. If you pay out half of your revenue to wages, then the return on capital is halved. The way in which you can avoid that is by incurring debt rather than issuing equity. So, as far as I can see, there's an essential relationship between methods of remuneration and capital starvation in a way which is quite different and on top of the various factors that John mentioned. Do you have any thoughts on that, please?
Well, payment depletes cash. In fact, in one of the more creative moves by the interim financial policy committee in this country, that was a good one, while before it was the permanent one was established, and since was that they actually told banks to pay bonuses out of newly issued equity, which would not deplete the cash as much. So, but in general, obviously, bankers' compensation is high. I know of only one place, it's very rare, that they actually cap the pay. And then, of course, the bankers will say, oh, you couldn't get good people to do it. Well, I think it's still high enough. In the book of talking to different bankers, and the author was asking them whether they thought they were being paid fairly relative to people they went to elementary school or high school with who are doing other jobs. And many of them felt a little bit guilty about how much money they're making in banking and finance. So I think there's much room to maybe, the entitlement to such pay might not be.
Yes, but I'm sorry, my point was a slightly different one, that profit sharing distorts the marginal return on capital, and it's an issue of the marginal return relative to the marginal product rather than cash depletion that was concerning me.
Well, I mean, I'm not sure how I'm not sure that that's where the exact margins are that they're making a given loan, or coming from a corporate finance perspective, there is a loan to be made or an investment to be made, and there is funding to do it, and that's true for all corporations. And how they structure, labor contracts or whatever. But I don't know. But John, do you have any more to add?
Well, no, I'd take Martin's point, but and yours, Anat. Yeah.
Okay.
Who would like to? Yeah.
Thanks. My name is Rufus Fraser, and I work at an investment fund in London. I just wanted to ask a question about this concept that equity is more expensive. So just to clarify for myself. So my kind of assumption was that banking was a commodity industry, and that one loan being just as good as another. And so, and broadly speaking, I think if you looked at the UK over 100 years, the industry has generated 10% a year or whatever. So if we said that we want to take the proportion of equity in the capital structure from 5% to 15%, then the industry would just reprice to triple earnings. And because the return on equity would have to be the same. And therefore, I think that's just the definition of a commodity industry. So
I don't know what you mean by commodity industry. Every industry does stuff and invests, okay? Nobody's entitled to a particular return on equity. Return on equity is related to risk, at least in the required amount. There's a randomness in the in the earnings, and there's investors requiring return. The required return depends on risk. So I'm not sure about the tripling or whatever. This is a competitive market of pricing the loans. So, you will price it by its. But in any case, maybe we can discuss it offline, but there are ways of thinking about it that are not quite right.
I'm okay, fine. But all I was doing is making the assumption that the ROE in the industry would not change.
This is a wrong assumption, because ROE has different kinds of things. ROE is a function of the return on assets. Okay, return on equity is something that gets realized. You can aspire to have one, but there's then a realization of it, right? I mean, your returns on whatever you do are uncertain when you make the decision, right? So now we're talking about for a given risk, what the market would require of your debt and equity. This is very basic corporate finance, what we teach in every industry. Everybody takes risk, and everybody has investors that are getting the, return that they require on average. Sometimes it works out better than other times. But anyway, we have 2 chapters on this topic, and the book right now, I should mention, is on 50% off sale, which makes it under £10. So this book is free almost. And I'm happy for you to approach me after you reflect on your question. Because all companies make commodities. I mean, when I'm told banks are taking people's money and creating loans, every company takes investors' money and turns it into assets. So there's nothing special there. So I don't know exactly what you mean by the words commodity business. So maybe I'm missing something.
Do you have a question here?
Thanks. Tom Elliott, I'm a visiting lecturer here.
Did you want this?
Oh, sorry. Thanks. Tom Elliott, I'm a visiting lecturer here. And I wondered if, in thinking through this unholy relationship between politicians and bankers, whereby the general population is sort of told, don't worry yourself, there are guarantees and everything. Wouldn't a solution be to actually stop those guarantees and make the man or woman in the street be very, very alive to the balance sheet risks of each bank that would then be reported better, and there'd then be pressure on the politicians and the regulators to uncozy themselves.
So after we describe get to the point of describing the crisis, we say precisely what you said. Wouldn't we like to let them fail and stop, and not bail them out? And then we go into the desirability and the credibility of this thing. In other words, many people claim that, they should have bailed Lehman out. Okay, and we're saying they shouldn't have even bailed out Bear Stearns. So you could go both extremes here. The problem we have right now is that we don't have the mechanism to handle, especially in the cross-border, to handle, at least for and in the book, we actually, when we assert with complete certainty that for global systemic bank, meaning banks that are operational across borders and are important in many places. So this is the list of about 30 of them, now down by 1, because Credit Suisse was on it. For those cross-border banks, and of course SVB was not one of those, it was just a small bank in the US, but for the large ones in particular, there's literally no way to have this happen without collateral harm. That's the dilemma. That's the hostage situation we're in, that the options are bad, which is why we're about an ounce of prevention, okay, from that stock choice. Now, we now say, because the cross-border thing is unsolvable politically, because of jurisdictional issues, it's not going to happen. I was part of a Systemic Resolution Advisory Committee in the US, and in a big victorious moment, Paul Tucker was coming to visit, who was the deputy governor here, to declare that the US and the UK agreed on something that we discuss in the book called single point of entry, meaning if Barclays fails, then the UK will manage it, and the US will just allow the UK to manage it. And if it's JP Morgan Chase, then the US will manage it. So they're not scattering into what Mervyn King was saying, dying locally while living globally. So Lehman Brothers had lots and lots of bankruptcies and insolvency procedures in lots and lots of jurisdictions. And when in that meeting, which was public, a committee member or a member of the media was asking the chair of the FDIC whether, in fact, he can assert to us, sitting in the room, that the US would let the UK handle the resolution of a Barclays or an HSBC, he said, I cannot promise that. So right there, in the moment where they were about to say to us their great accomplishments, they couldn't even make that promise. And even if he made it, it wouldn't necessarily be credible, because then Congress is going to say, what? This is the United States. We're not letting any other country. Who are these people? We are the United States. So politically, politicians want to protect their own citizens, and they will not let a foreign country, decide who loses what. So we end up questioning that we need such institutions at all. They are out of control in multiple jurisdictions. They cozy up to the home government or something like that and have them go lobby for them elsewhere. And it's not clear that we shouldn't restrict banks back to being within at least a jurisdiction. And they can have arm's length connections and SWIFT transfers and whatever else we can do electronically today, but they don't have to be under the same corporate umbrella. But even for small banks, it's oftentimes, in the case of SVB, there's now a debate, and this is a case in which they give way excessive bailouts, and they really shouldn't have, and they shouldn't be bailing out all the banks right now. They should recognize their insolvency, because they are repeating exactly the playbook of the savings and loan, in which they allowed the zombies to persist for almost a decade, only for the taxpayers to have to pay the price. So you can extend and pretend and forbear all this time, and it doesn't end well, usually.
Perhaps I could just add on the point you're making about how to spread a psychology of greater prudence and awareness of the costs of excessive risk-taking. There has been a bit of discussion among academics about whether it would be possible to reintroduce unlimited liability into the top levels of banking. And unlimited liability is a fantastically good control mechanism. Yes, it is indeed. If you Google Charles Goodhart, you will find.
I'm going to debate this with him tomorrow.
But it's very interesting. I mean, for example, if you look back at the 1929 crash and the subsequent banking crises, Goldman Sachs, which was a partnership, did not go bust, but Goldman Sachs Trading Company, which was an associated limited liability trading operation, did. And a lot of the banking damage was in the limited liability part of the banking system, less in the unlimited liability part of the banking system.
Lloyd's names took the government to court, didn't it? When the government tried to enforce, the government won, but it took a legal case.
Take their own assets, the bankers' own assets. Yeah. Good luck to us.
Yes. Norman Cumming, Clare College. You make an eloquent case for the capture by bankers of politicians and regulators. At least in the UK, the market value of the equity of big banks is systematically below the book value. Why has the stock market not understood the fantastic option value that's out there?
Well, just for perspective, to those of you who are not finance experts, usually a book value or reported value of the equity of a corporation in almost every sector is meaningless so low, because most companies have growth and the stock price is reflecting the future cash flows. The fact that in banking you can have a market value below book value is really quite a sad commentary on the business model, because the business model relies on a lot of subsidies extraction and passing on risks and costs to other people's tax savings and all of that. Now, there's great opportunity, but there's still losses. I mean, Credit Suisse, Citigroup, I mean, if they were a normal company, they would be bust. There would be no equity. So the equity still has an upside value, but they do lose, okay? So, it is shocking that, how long really badly managed banks actually survive and don't die. So what I'm saying is, the business is just not well managed, is wasteful, is inefficient, and it's surprising it's alive at all. In other words, in my book, the banks are displaying zombie symptoms all the time. So I don't even know why any of them has any positive equity value to begin with. I mean, because of the bailouts potentially, and because there is an upside, but.
Can we go to the back first?
Hi, I'm a first economics student at King's. So my question is, how do you assess the trade-off between increased regulation in banking and the potential that would have on decreased economic growth? Because you would see that every single time that it's easier for a bank to multiply its money, there has been higher economic growth.
So that's a meme that they say, and we start responding to that kind of question by saying that the biggest drop in output was not because the banks were too well regulated. So, the financial crisis was the biggest decline in output. So this notion that somehow unregulated banking is good for growth and the boom and the bust that we get is not at all clear. Now, the banks that we have today, the system that we have today in the West, in the US, in the UK, in some other parts, the developed finance, is just too big a system. It's not doing what we need. It's doing a lot of other things within itself. It's look at, who was it? I'm forgetting the name. There's very little out of the total that slushes around that is interacting with the real economy at all. So all of this is a nice story, but it doesn't reflect what we're talking about. If the banking system shrinks, the economy could be better off for it, because there's plenty of size in this sector to do what we need. The incentives are wrong, so they'll invest in derivative other things. They're not necessarily productive always. So having a hedge fund with a side business of lending when you're having a bank that puts deposits in the central banks and not lending it today, they're not even lending. In the US, colleagues of mine did a study showing that much of the lending is now done by shadow bank anyway. Shadow bank, meaning other industries participants, and they have 20% equity without regulation. So the entire story, both the threats that the people will go into and dangerous unregulated section, maybe the unregulated section, because it doesn't have all the safety nets, is responding more to market signals and is actually better capitalized. The paper shows that for non-bank lenders in the US by a few economists. And so, meanwhile, the big banks have huge, trading operations in the trillions, some reflected on balance sheets and some not. So the quaint view of banking as doing whatever, you learn in a first course is just not true for today's banks.
I think you were probably fishing for the name of Adair Turner, who was famous
Adair Turner was
for his critique.
3% go out.
He was basically saying that the social utility of much of what the modern banking system is doing is very low. And that relates in very much towards the derivative trading and structured product activity that was going on before the financial crisis. But you were going to make a point, I think.
Hi, I'm Amrita Dhillon. I'm a professor here at the Department of Political Economy. So my question was about the equity point. So is there a paper or research showing that there is a causal link between having this too big to fail moral hazard and low equity, right? I mean, that's the argument for why banks have low equity compared to other institutions.
It's not just, so our paper on this subject is showing that every So I'm a theory person. There are papers, there are various empirical papers. This is almost too obvious a point because we see it so clearly. But the paper on leverage ratchet shows that this is a general corporate finance paper that shows that any corporation that gets heavily indebted would go ever higher towards leverage. And that's true for corporations that are about to file for bankruptcy. They will take the money out, which increases their indebtedness, as a form of gambling for resurrection, because at that point, they're playing with the creditor's money that would be in bankruptcy, which is why insolvency courts, bankruptcy courts, would claw back such transaction and invalidate them in what's called fraudulent conveyance, because ahead of a bankruptcy, you want to take the money out to yourself to protect it from the creditors. So that close to insolvency, incentives get very wild. And in banking, because they don't default and don't go into bankruptcy, then it just kind of persists in that way. But you saw in my general history of banking that we used to have 20, 30% in banking in the early 20th century. So in a broad sense, we saw a huge decline in levels to the point that they're now kind of stuck there and in a bad place and need a lot of help being pulled back.
And part of that change is to do with the wider use of limited liability, right, which is morally hazardous.
The increased liability and the safety net that evolved, an increase plus the ability to hide risk. I can tell you that I talked recently apropos this discussion of partnerships and limited liability corporations. In the end of the book, but not the movie, The Big Short, Michael Lewis reflects on the very epilogue of it, reflects on his first book ever that he wrote back in the late 90s, Liar's Poker. Liar's Poker describes this crazy culture and all of that. And as he reflects on it, he's meeting up with John Goodfriend, who took Solomon Brothers into corporation from partnership. And he thinks that was sort of a formative event, the move of investment banks into limited liability corporations. He ends the book by saying the problem was not that they didn't bail Lehman out, but the problem was they had allowed Lehman to succeed. Now, very recently, I spoke with somebody who actually was a partner at Goldman Sachs, I will not mention the name, during the time that they decided to go public and stop being a partnership. And he was telling me about the process that led to it, because the partners had to vote to do this. And in a bit of maybe, inside scoop, whether it was said or not or just implied, the notion was that in the situation at the time already, with all the derivatives and all the ways to take risk. Oh, back to Michael Lewis. Michael Lewis said, the minute they became corporations, in the case of the bank, and this is to the opacity, the people whose money was put at risk got farther and farther from the risk that was taken, and the more complicated it got, the less they understood what was done with their money. So that's to the point of really being unable to monitor the risk, even as a shareholder. What I was told was that the partners of Goldman Sachs were told that, or it was implied to them, that it's not true that becoming a public company and a limited liability corporation is going to now mean that they have to be more transparent. They were, that fear they were being told is not justified because they will be able to hide a lot of risk. So even though they are technically have to do more disclosures as a public company.
My name is Paul Greatbatch. I'm a visiting fellow here at King's College, and my role tonight is official timekeeper. We've been talking for an hour and 10 minutes. It's hot. I think we all need a drink. Sadly, we're not going to be able to provide it at King's College tonight, but Anat will be around to answer questions individually for a while longer. Sadly, she can't sign your copies of her book, but she can sign your discount vouchers.
They have these labels. You can just paste it.
If that's an appropriate memento of this evening. But could we thank Anat for a really excellent tour d'horizon?